Good evening, I'm Alessio, and thank you for joining me for tonight's business and finance briefing. We're focusing on a story that underlines both the vulnerabilities in the food service franchise world and the wider lessons for investors, franchisees, and creators alike. The company at the center of today's update is Jack's Donuts of Indiana, a chain with a long history in the Midwestern retail food sector, now grappling with a Chapter 11 filing that raises big questions about structure, strategy, and risk. The filing by Jack's Donuts of Indiana Commissary LLC was submitted on October 29 in a U.S. bankruptcy court for the Southern District of Indiana, revealing approximately $14 million in liabilities against assets of just over $1.4 million. Hoodline: the commissary in question refers to a production hub facility that opened in 2023 and to which multiple franchisees were required to shift the production of their donuts instead of continuing to bake in-store. Mashed, according to reports, some franchisees believe that this consolidation move adversely impacted their customer experience. One franchise owner told local media that switching to the commissary-supplied product meant customer feedback compared the chain less favorably, likening it to a gas station donut. Mashed: the outcome is a company that, despite decades of existence, founded back in 1961, now finds itself restructuring. Mashed: what does this all mean in practical terms for the business, the brand, the franchisees, and the investor ecosystem watching closely? First, the Chapter 11 status means the company is seeking to reorganize rather than liquidate, so the core brand and franchise operations are meant to keep running. In fact, on its public Facebook page, Jack's Donuts reassured the public that our stores remain open. Our commitment to quality, tradition, and community remains unchanged. Facebook: the chain's franchise footprint is not being shut down outright at this moment. Yet the path forward will hinge importantly on how the company addresses the structural problems that pushed it to this moment. Over-centralized production, franchisee dissatisfaction, a mismatch between brand promise and consumer experience, and mounting debts. Second, from a governance and franchise model lens, this story is rich in lessons. The move to force franchisees into using a central commissary might have been intended to gain scale, reduce costs, or standardize quality. But when franchisees report that the end result degraded product quality or customer perception, you have a structural risk creeping in. The letter submitted by franchisees to CEO Lee Markham earlier this year accused ongoing mismanagement and troubling financial decisions that directly impacted operations and eroded confidence in the company's future. Mashed: for any advisor, franchise investor, or creator producing content around the space, the message is clear. Model changes inside a franchise network must always preserve customer experience and empower the local operator, or you introduce a hidden strain. Third, for the broader investor or brand watcher, the Jack's Donuts case reminds us that even heritage brands are not immune to disruption or missteps. In a competitive market for breakfast, fast casual, convenience, and bakery items, consumer expectations are high. Operational shifts, like moving from in-store to central production, can alter anything from freshness to perception to staffing models. That ripple effect matters financially when franchisees start losing customers, margins get squeezed, debt builds, and the brand starts showing cracks. A liability of $14 million isn't trivial for a network that once boasted around 24 locations and 14 franchisees. Hoodline: fourth, this case also illustrates one of the less remarked upon but critical factors in the franchise world: the alignment between corporation and franchisee. When franchisees feel forced into operational decisions that harm their business, when a centralized system changes the product or costs or service in ways they believe degrade their competitive position, you have a breakdown of alignment. That misalignment, left unattended, can lead not only to franchisee dissatisfaction but also to financial strain and reputational damage for the entire brand. Franchise investors, advisory firms, and even content creators who cover brand investment models should pay attention. The story isn't just about brand value or growth, it's about ecosystem health, partner alignment, and execution. From my perspective, we are seeing a teachable moment. As Jack's Donuts enters the Chapter 11 process, the company will need to demonstrate that it can reorganize effectively, service creditors, maintain franchisee engagement, and perhaps restructure its production/distribution paradigm in a way that realigns with consumer expectations. If it succeeds, it may emerge stronger. If not, it may become a cautionary tale. For viewers, investors, and creators in the ecosystem, the takeaway is to monitor not just headline growth or location count, but operational shifts, franchisee sentiment, cost structure changes, distribution/logistics transformations, and debt levels. Looking ahead, the signals to watch: whether Jack's Donuts can secure approval for a viable reorganization plan, how the commissary model evolves or whether it is spun off or modified, what the company communicates about franchisee support, capital structure and supply chain sourcing, and importantly, how customer sentiment and sales respond in the coming quarters to any changes. For creators producing content around franchising, fast casual brands, or food service investing, this story provides a rich lens. Market legacy counts for something, but execution, alignment, and adaptation matter as much, or more. Thank you for tuning in this evening. I'm Alessio, and that was your business and finance update on Jack's Donuts. Stay alert, stay informed, and remember, in the world of franchises and finance, the flavor of success often depends on ingredients you can't always see.